we've got oil hovering above $100 a barrel. This is despite the slowdown in its top importer. As we say, you are seeing some further upside. But what would oil prices look like if we didn't have these lockdowns in China, and how much is that complicating the picture?
Yeah, well, I certainly think the market is assuming, that the lockdowns are resulting in significant hit to demand, and in a sense, offsetting, the potential supply shortfall that we may see from both, the EU ban on Russian oil, but also, the lack of growth that we're getting out of OPEC group as well. And we're talking obviously, 2 to 3 million barrels a day. I mean, our estimate of the demand hit in China is only about 1 million barrels a day at the moment, but obviously, has potential to grow if we do see that outbreak really spread across the rest of the country, and those lockdowns really start to bite. But it is a very complicated picture, and I think in the shorter term we're going to see this high level of volatility until there's a little bit more clarity around what the supply and demand outlook looks like. But for us, the second half of the year looks extremely tight. I mean, we do expect, obviously, the outbreak in China to eventually ease, and we see demand, recover quite strongly, just as we've seen in other regions around the world post, those lockdown periods. And that will come at a time when, the EU is pulling back on Russian oil, and we have very little inventory to really buffer that tightness.
So you've got a year-end target for Brent, $120 a barrel by the end of the year. When you're talking about hopefully some kind of rebound from China in particular by the latter part of the year, what does that mean for your view on the overall commodity complex?
Well, I mean, they've been pretty clear in China that they'll support economic growth with continued sort of stimulus measures, and that I think bodes relatively well for the wider complex. Although there'll clearly be some cautiousness from commodity markets, considering that the previous efforts haven't been that successful. But I do think that it will provide just a fillip for markets which have been obviously just languishing in recent times. So we have a pretty positive view then on the metals complex, and even iron ore and steel as a consequence of that government support that we expect to see come through in the second half of this year.
Daniel, looking at the whole gamut here, a lot of this has naturally come from what we've been seeing in Eastern Europe, and especially food prices. Now, how high can they go, and is there any way of perhaps mitigating that?
Yeah, well, that's a tough one. I think we're getting a perfect storm in a sense, where supply disruptions are really quite significant, and at the same time, demand is certainly quite strong. So it's hard to see how we get out of this situation. I mean, there are inventories, relatively high inventories, certainly compared to other commodity markets, which will certainly help alleviate some of that pain in the shorter term. But they'll have to be restocked in coming sort of months or years as well. And if these supply side issues really persist, then it's hard to see how agriculture and food prices will diminish in the shorter term. So that has obviously quite significant implications for the wider economy and within commodity markets as well. So we think there's once again probably a little downside in the medium term on that side.
Very quick word on before we leave things on energy, and with the European Union sanctioning Russian crude oil, where does that leave that oil to go now?
Yeah, as I said, I think the market is still unsure on how the demand picture looks in China. So I think we'll see things relatively volatile. But as those sanctions come into place, and the Europeans have obviously said it'll be a phased approach. So we won't see that tightness emanate quick all at once in the shorter term. But as that builds, we expect to see prices continue to grind higher, more of a 2 steps forward, 1 step back type of scenario. But you throw in other things like the US Department of Energy restocking its strategic reserve. It really bodes for an extremely tight market. So we do see prices continuing to edge higher from here.
Daniel, we're seeing daily power blackouts in the likes of India and Pakistan. How much worse do you think the global power crisis could get?
Yeah, well, I think this is at the crux of the issues at the moment. Is these obviously weather events. We've seen obviously some cold winters in previous years really hit the energy complex, and now we're seeing these heat waves in India really push energy systems to the brink. And look, there's no really easy way out of it. I mean, obviously, a lot of the energy complex is being pushed into increasingly few options, I suspect, to really boost output. I mean, India itself is going to have to delve more into LNG and coal as a consequence of that, and I suspect Europe is the same as well. So for electricity prices globally, it's once again, it's going to be this constant upward pressure as utilities look to higher priced fossil fuels, in a sense, to really expand that generating capacity that they're really pushing at the max at the moment.